Good morning, everyone. I'm Peter Stanton, publisher of the Worcester Business Journal. Welcome to our Business Strategies for Coping with COVID-19 webcast series. Today's session is the latest on the PPP loan forgiveness. Since the pandemic hit back in March, business scrambled to apply for the PPP funding. Flash forward 2 months later, and many are coming to the end of their initial 8-week period with an intense focus on maximizing the forgivable portion of their PPP loans. But just when you thought the dust might be settling on how to complete that process successfully, our leaders in Washington just last week made further modifications to the PPP program that significantly changes the forgiveness calculations for many small businesses. Today's session, we'll hear from a panel of experts on the new law, what changed in the guidelines, what those changes mean to you, and we'll identify the elements of the law that are still unclear and will need further guidance. Our full COVID-19 crisis webcast series is being sponsored by Webster 5 and Fallon Health, while Bowditch has loaned its support and deep expertise to today's PPP session. We appreciate the leadership and commitment to the community of all three of these fine organizations, which allow us to create this critical programming and bring it to you for no charge. A recording of this webcast will be made available online at Worcester Business Journal's website, so you'll be able to send a link to anyone who could not join us live today, and we'll also follow up with access to slides and other key links. I'm going to be your moderator, and we have a terrific panel of 3 experts from the field of law, accounting, and banking. Our panelists are Rory Fazendiro, a partner at Bowditch & Dewey. Hi, Rory.
Hi, Peter.
Alan Osmolowski, who is an industry partner and leader, TLC at Bloom Shapiro. Hi, Alan.
Hello, Peter. Hi, everyone.
And John Manila, who is a vice president and team leader of business banking at Webster 5. Hey, John.
Hey, Peter. Thanks for having me on.
No problem. It's great to have you. Our first presenter is going to be attorney Rory Fazendiro. Rory is a business-focused attorney whose diverse practice includes corporate and real estate transaction matters at Bowditch. Before receiving his law degree, Rory worked in professional baseball and also coached at the collegiate level. So, Rory, we assume there'll be a few baseball metaphors in your presentation. It's all yours.
Thanks, Peter. Thank you for having me be a part of this. Thanks to the Worcester Business Journal, to Alan and to John for presenting here with me, and to everyone here who's joined us. I'll try to fit in some baseball analogies, but the one that I think fits best is it reminds me of a roller coaster and a ride that I think we've all been on since April 3rd of 2020 when this program launched. I'd like to, I think, focus today on the most recent modification to the PPP loan program, which was signed into law on June 5th, 2020, last Friday. That changes some significant and fundamental parts of the program that affect all borrowers. So we'll focus on that and answer some questions for sure. But why don't we begin on my first slide? Thank you. So just, kind of where are we now? Well, a few statistics. This program launched April 3rd, 2020. I think if my math is roughly correct, the borrowers who receive funds right at the outset are probably very close, if not at the point of their 8-week period by which they were to use the loan funds. And now one thing we'll talk about today is that 8 weeks has been extended, and which is going to be extremely helpful, I think, for many borrowers in a couple different respects. There were over 4.5 million loans that have been distributed with an average loan size of $113,000. The total authorized funds over the 2 tranches of the fundings is approximately $660 billion. And although the first round of money went fairly fast when the program began, there's still over $130 billion in available funding for this program as of, I believe, yesterday. But I think the important thing to know, and there may have been a few questions about this until very recently, this program is going to be available for loans only until June 30th of 2020. So by the end of this month, all applications will have to have been submitted. So despite the extension for the time to use funds, the applications, if a borrower hasn't, or if a business hasn't yet applied for one, it appears that right now June 30th will be the deadline to do that. I think a tricky part of this program, since it was instituted, was staying abreast of the continuous changes, guidance, explanations that SBA and Treasury have issued. The CARES Act, I guess, would be the primary source of the law and what the program requires. That's sections 1102 and 1106, which is the forgiveness portion of the CARES Act. But I think a lot of us have really tried to keep up with the various guidances, frequently asked questions, and ultimately the interim final rules that that SBA and Treasury have put out, which have not always been at a time when most convenient for us to understand the nuances, but they've certainly been helpful when they've been implemented. This most recent legislation amends the CARES Act. It was signed into law last Friday, and I think the important parts are it modifies certain fundamental loan terms and a couple of the most important rules relating to forgiveness. And what it ultimately does is provides borrowers with some flexibility and additional time in order to meet forgiveness eligibility. The availability of the loans, as I said, the deadline to apply remains to be June 30th, 2020. That was something that was clarified just recently, I think yesterday, by SBA and Treasury. The first and maybe the most important change of the, I'll call it the Flex Act, that came out was that the covered period of the loan increased from 8 weeks to 24 weeks. So importantly, from the date a business received its loan funds, the business now has 24 weeks to spend that loan money and for purposes that the CARES Act allows. So that's for payroll, for rent and mortgage interest, and for utilities. That 24 weeks obviously allows businesses to use more funds for payroll, extends it out over a longer period of time, and allows also the same to happen for rent and mortgage interest and utilities. If you're a borrower who received a loan prior to June 5th, you may elect to stay with the 8-week period. I think that's a question a lot of borrowers must have. But I think the way I'm looking at this and recommendations I'm providing is, unless you're absolutely certain that you've been able to use your funds and you're fully able to get forgiveness of the entire amount of the loan, there really wouldn't be much of a reason to stick to the 8 weeks and try to get that forgiveness application in now. If you have gone through your funds and you can do that, then I think that's probably something that you can consider. But I think the additional time for most borrowers is going to be useful to help spend the loan amounts in the way that's authorized under the law. Another very important thing is SBA and Treasury are, quote, promptly issuing further rules and guidance to help explain some of the questions that may exist regarding the modifications to the forgiveness rules. And most importantly, also, there will be a new borrower application form that will be issued by SBA. We don't know when that'll be out, but indications are that it will be promptly issued. So we really don't see much of a reason to use the old form of application. My take on it is it may present some issues or difficulties when it's being reviewed if there's a newer and updated, more updated application. This is the next slide. So another major change to the program, I think we may all remember that there was a requirement for full forgiveness that 75% or more of the loan proceeds have to be used towards payroll. So that has been changed and that percentage has been lessened. I think that's been a huge help, and that will be a huge help to businesses that may have been closed for the last several weeks or may have been working at reduced capacity. If you can only have 50% or less of your employees working for you, you may not have been paying them. So the reduction to the requirement towards payroll at 60% and not 75%, I think is going to hopefully provide flexibility and some additional ease for borrowers to spend as much as they can towards payroll, again, over now a 24-week instead of an 8-week period. A question arose as to whether if you don't use 60% of the loan towards payroll, are you then not eligible for any forgiveness? I think that was a concern for some initially, but I think as of yesterday, it was indicated and confirmed by SBA and Treasury statements that if you are unable to use 60% of the loan, let's say 55% towards payroll, you still would be eligible for partial forgiveness. And what we know on that is that partial forgiveness is available subject to at least 60% of the loan forgiveness amount used towards payroll costs. So if your loan forgiveness amount was calculated to be $90,000, 60% of that would have to be used towards payroll. You're going to hear from us a lot that we should expect further guidance on this in the upcoming days or weeks so that these issues may become more clear. Next slide, please. Another important aspect of the Flex Act that has changed as of recent times is a safe harbor that relates to forgiveness with respect to a business's employees and any reduction employees. So that rule has not changed. There's a certain point in time when you're going to have to measure the employees that you had at a certain date at the end of the covered loan period and measure that against certain reference periods in the past. Now, the one thing that's changed is that the covered period has been extended from June 30th to December 31st. So, the point in time in which a business will look at the number of its full-time equivalent employees and compare that to past times is now December 31st, we believe, instead of June 30th. There is also, the Flex Act provides an exemption from forgiveness reduction based on what they call employee availability factors. And I think these scenarios came up quite a bit. Now, this will happen if you have a reduction in your workforce. If you have an inability to rehire a worker that was employed on February 2020, or if you have an inability to rehire a similarly qualified worker for an unfilled position by December 31st, and you document that, you would be subject to having no reduction in forgiveness. In other words, that wouldn't be counted towards your measure of full-time equivalent employees on December 31st as compared to the two reference periods. There's an additional safe harbor. That's the last bullet point on the slide. If the borrower can document an inability to return to the same level of business activity in prior to February 15th, in light of having to comply with the safety, sanitation, or social distancing requirements that have been issued by HHS, CDC, or OSHA, between the March period through the end of the year. If you were able to document that your business activity has been seriously affected by all of that, which I think a lot of businesses would be able to attest to, that would provide you a safe harbor from having fewer FTEs at the end of the year than you did on the 2 reference periods. An interesting, we again, will wait for guidance to see whether there's any standard or any indication as to what a business will have to show in order to meet these different standards and criteria. So we should all be looking ahead to that. And now I'm going to just turn it over to Alan, who's going to talk about different aspects of the Flex Act.
Hey, Alan, let me just give you a little intro. Thank you, Roy. That was terrific. Alan, again, is an industry partner and leader at Bloom Shapiro. He's a partner in the firm's tax practice and industry leader in the technology, life sciences, and clean energy sector called TLC. I interpreted that as tender loving care for your clients, but I guess
That as well.
and he also works with clients in the real estate and manufacturing sector. So Alan, you're on.
Great. Thank you, Peter, and thank you, fellow panelists, and appreciate the opportunity to be here with everyone today. There is a lot of things that are changing very rapidly, as was mentioned earlier, but a few more favorable changes that came out of the recent act. One has to do with the term of a PPP loan that's not forgiven. So, if you have a PPP loan, hopefully most people will be able to get the whole loan forgiven, but in many cases that's not the result, and there'll be some part of the loan that's not forgiven. And that loan repayment term under the original CARES Act was a 2-year repayment term. Now that has been extended to 5 years, which really makes a lot of sense on a lot of levels. In addition, the date of when repayment starts has been pushed out. Basically, it's been pushed out to a date when the amount of forgiveness is determined and remitted to the lender. That is when the debt service will start. For recipients who do not apply for any forgiveness, they have 10 months after the last day of the covered period before the first payment is required. So again, it kind of pushes out the start date of the debt service on the unforgiven portion of the loan. Next slide, please. The other favorable change that came had to do with expanding the ability for deferral of payroll taxes. So in general, the CARES Act allowed deferral of FICA taxes until the next 2 years. And so you could defer any FICA taxes that are owed during 2020 and pay back half at the end of 2021 and half at the end of 2022. So it's really, it's a deferral. It isn't a permanent exemption from paying them, but it does help from a cash flow perspective. But under the law, as it was originally written, at the point where a borrower of a PPP loan received any forgiveness, they would no longer be able to defer any of their payroll taxes. That's now been changed so that even if you have a portion of the PPP loan forgiven in part or in total, you're still able to defer those payroll taxes. Next slide, please. One issue that was not fixed, that everybody thought was going to be fixed, had to do with the deductibility of expenses that were paid for by the PPP loans. The original CARES Act specifically stated that any PPP loan amounts that were forgiven under the program are excluded from a borrower's gross income. So Congress didn't want borrowers to have to pick up income because this loan was forgiven. That was definitely clearly their intent. But one thing that was not addressed in the original act was other parts of the tax code that come into play. In particular, there's a part of the code that says if you have an expense that's reimbursed, you can't claim a deduction for it. And so that's where the IRS came out and issued notice 2020-32, and they concluded that applying Internal Revenue Code 265A1 to the CARES Act would preclude the borrower from claiming a deduction for the expenses that were paid with the loan proceeds. So it's kind of the same thing as having to pick it up as income. If your taxable income, if you have $100,000, let's say, a PPP loan and you get the whole $100,000 loan forgiven and spent the $100,000 on eligible expenses, including payroll, utilities, mortgage interest, et cetera, you're going to have to add back those expenses on your tax return, and essentially will have $100,000 more of taxable income. So, the drafters of the original bill said this was not what they intended. They said that they were going to work on a fix for this issue. And everybody thought that this, last bill would include something in there that would address this, but as of right now, it has not. And I think, the IRS issued the notice more to highlight the fact this issue exists under current law and needs to be corrected by Congress. So we'll keep an eye on that. And that's it for me for this part of the presentation.
Terrific. Thanks, Alan.
Thanks.
And so next is John Manila, who's the Vice President Team Leader for Business Banking at Webster 5. John has had a banking career of over 25 years where he specialized in working with customers in manufacturing, healthcare, education, and the nonprofit sector. And I know John and his team at Webster 5 spent a number of late nights and long weekends processing the gold rush of PPP loans back in early April that Rory started talking about. And so that now that we're approaching the fulfillment side of that forgiveness process, it'd be great to get your perspective, John.
Well, thanks, Peter. We for a little while there, we felt like accountants under the former April 15th date for sure, under the gun. So it was interesting, but I'd prefer not to have to do that ever again. Well, again, thank you for having me on, and thank you to my esteemed panelists for joining me here. So my responsibility is to talk a little bit about the general process for forgiveness. So what really we start with, obviously, is the borrower completing the forgiveness application prepared, from the SBA, and submitting it to their lender with all additional documentation provided. So, could be quite a large package. In the way that is submitted to your financial institution or lender could differ in several different ways. It could be emailing them directly. It could be an online portal that's encrypted, but that's still to be determined in all likelihood by each of the lenders. So at that point, the lender has it in their hands. They have 60 days to be able to issue a decision on the forgiveness to the SBA. So during that time, we're back in the bunker. We're going through the documentation, again, with the idea that we want to see as much, if not all of these forgiven as well. Certainly there's not much incentive from our standpoint to see any borrower with a loan on its books. But at the same time, we all operate under different limitations for sure. And then finally, we move, assuming the lender agrees to a particular amount of forgiveness or the entire amount for forgiveness, we then move forward that application for forgiveness onto the SBA. And the SBA then has 90 days to be able to review the application, unless, of course, they require some additional information. So that's kind of the general overview. Now, now we can start to get into a little bit more of the nitty-gritty of what that will mean for borrowers. So again, what the lender is required to review and confirm. We're looking to ensure that on the application that all of those little check boxes are signed off on from the application. Again, this is the borrower's good faith effort that they're in compliance, that there's no fraud and misuse of funds. So you're really putting yourself on record there. Then the next step is to review all that documentation that was provided related to payroll and non-payroll costs. Some cases that could be pretty easy. Some cases it could be, rather cumbersome and time consuming. But nonetheless, whatever's provided is going to get looked at. And then the calculations on the borrower's forgiveness application are reviewed along with the documentation to ensure that the amounts are equivalent, and also to see if there's any ways that any additional information that might be needed to support that application. And again, it's, the lender is performing a good faith review in that 60-day time frame in order to apply for forgiveness. So as we move on to the next slide, we have recommended documentation, which I think is prudent to be able to provide. Hopefully most, if not all, borrowers have a third-party payroll service, because that would make things a whole lot easier, because the level of detail that's being required in some cases for borrowers that may have upwards of 200, 300 employees, that can be a bit of a daunting task otherwise, to be able to list out each individual employee by an identified figure or employee number, if you will. And so in addition to those backups related to payroll, we'd also be looking, possibly for tax forms, again, from third-party payroll service providers, so that we can determine the covered period or the alternate covered payroll period that the borrower has selected. Again, all that needs to be verified. And then finally, we also have payment receipts, canceled checks, or account statements documenting the amount of any borrower contributed to employer portion of health insurance, retirement plans, and so forth. And as of now, that would go on PPP Schedule A, line 6 and 7. However, everything is subject to change. And as was previously mentioned, the Flexibility Act extended the covered period from 8 weeks to 24 weeks. So in some cases, that could be a great opportunity to be able to get the house in order, if you will, if, for instance, there was an issue being able to hire some employees back, or there happen to be some employees out on, say, workers' compensation and so forth. Again, with the idea to try to maximize that forgiveness. So our next slide. So again, we have other documentation which relates to the other expenses, if you will, which are included, like mortgage interest or lease payment interest, business rent or lease payments, as well as utility payments. So in the case of loans and mortgage payments, you'd want to make sure that you can back that up with the amortization schedule, specifically the interest expense that was paid during the covered period. And more importantly, need to go back and look again at the original application when filed for PPP, when they said that these needed to be in place as of February 15th, 2020. So if you just recently got a loan during this period, that's not going to be included. In terms of rent and lease payments, if there's an existing lease, that would be a good idea to include, along with canceled checks, ACH payments, however that payment is made. And just like with the interest expense adjustment that you're looking to take for expenses, that also needed to be in place from February 15th as well. Just indicating that, if you moved from one building to another during that point in time, there's going to be a portion of expense that is not going to be included. And then finally, related to business and utility payments, same thing applies. You need to be able to back up those payments made during the covered period with receipts, the actual invoices, so that you're kind of protecting yourself and providing that vital information that's needed to be able to verify that all is well. Next slide. And I guess we can't reinforce this enough, that from the perspective of the Federal Register and the SBA, all of the onus is placed on the borrower. So from that perspective, we're looking at the PPP forgiveness application, that you're attesting, each borrower is attesting in good faith that the information that they're providing is true and accurate. And specifically, the key component here is that the SBA, has indicated that they will look back for, within a 6-year time frame after the PPP loan application has been filed for forgiveness and forgiveness has been provided. So that's kind of a long window to be able to hold on to that information. And I guess from that perspective, I would suggest it would probably be a good idea to set up a separate file, hard copy, digitally, to be able to make sure that you have that backup just in the event that the government comes knocking on your door looking to audit for that. So that's kind of the general process for forgiveness. And I'm willing to bet that there's probably a few questions out there.
John, you got that right. There are a lot of questions. Many of them were submitted when folks registered for the seminar. And then a lot of them have been coming in live as the session is being run. And so I was gonna start with some of the questions that were sent in beforehand, but I'm gonna start with the most popular one coming from folks who are asking it live, and that is clarification about the 8 weeks versus the 24 weeks. Can someone choose element? Is there anything in between? Meaning, if I've successfully used up all my PPP funds and it's week 12, can I put my forgiveness application in then, or is it an all or nothing 8 weeks or 24? And just explain how, if there's any flexibility between the two. Rory, you need to turn your mic on.
Yeah, I think one aspect of it would be, unless you're assured that you have 100% loan forgiveness, there's really not a lot of incentive to file any earlier, because all you're doing is, starting the debt service on the unforgiven part of the loan sooner. That's one component of it.
I think that's a good point. There's really nothing definitive as to whether you can use some period of time in between 8 weeks and 24 weeks. My guess is that will be made clear when guidance is issued coming up here. Personally, it makes sense that if a borrower has used the funds in an appropriate way and has done its best for full forgiveness, a borrower may be able to submit their forgiveness application prior to the 24 weeks. But just because that makes sense to me doesn't mean that that's what SBA and Treasury will ultimately decide. So we don't know the answer yet, and stay tuned.
Yeah, like everything else, to be continued.
Right.
From that perspective, the other thing to consider is, submitting your forgiveness application, regardless if it's airtight, ironclad, you still open yourself up to the fact that the SBA could say, well, let's start to look at these applications now. And now they start to conduct an audit because they're one of the first ones that come in. Again, if you have a complete, fully accounted for package, then you shouldn't have anything to worry about. But if there's any kind of gray area there, the and versus or, is it really worth sending in sooner? That's the kind of the question that every borrower needs to grapple with until we know whether or not there's kind of you can send it in on a 12-week period or 16. So that's kind of my input as well.
Yeah, and just to kind of echo some of those comments. I mean, there's guidance coming out relative to this literally daily, weekly, and so there could be guidance that comes out towards the end of the 24-week period that may come out after you submit an application early, if you're even able to. So there's just a lot of variables there.
Understood. It feels like we could be doing this session, I guess, weekly for the next for the next month or two.
Yeah.
Just based, and you know, I think it's difficult for small businesses, right? Because you know, you're professionally studying this thing and are on the SBA site and looking at treasury documents that, you know, the average small business person is not chasing that down. And sometimes that guidance is in language that's a little hard to interpret. Let me get to the next. There were a set of questions around sort of sole proprietors or very small businesses. And I'm going to read like 3 of them that are all related, and maybe you can answer them, address this all at once. Question: I'm a DBA with employees. I normally take a weekly draw. Can I take draws from my PPP funds? Another one related: can the owner take draws from the 75% payroll portion of the PPP? And then another: how do the loans and forgiveness apply for people who are self-employed and have no employees? So we're really addressing the smallest folks. How do they make sure they are following this correctly and what's allowed?
So I think the answer to those questions is yes, but I'll kind of go through them to provide some needed color. You know, if you're self-employed or an owner employee, and for example, you're taking draws on a weekly or some other basis, that is counted towards payroll, and that would count towards the now 60% requirement for full forgiveness. There's a ceiling on how much can be paid out during the covered period, and as of right now, that remains at $100,000 annually. So, you know, if you're taking draws, that's still a ceiling that you won't be able to go over, at least as of right now.
Got it. Anything else to add to that sort of smallest sole proprietor kind of question? Are we good?
Nope.
Go ahead.
The only thing that I would add, Peter, is, you know, whether or not you're also going to be allowed to take that over 24 weeks as opposed to 8, which I would imagine from a common sense standpoint you should be able to, but I don't know that I've seen definitive language indicating that you can.
Okay, sounds good. One more clarifying question related to the 75% and the 60%. Those have been set as minimum thresholds, meaning if it's now 60% in the rules over the 24 weeks, if someone's at 58, that's not good, but if they're at 87% payroll, that's all fine, right? That is a minimum threshold. Is that correct?
That's correct. That's a minimum threshold to be eligible for full forgiveness on the payroll portion. Now, there's other potential forgiveness reductions, the two being a reduction in full-time equivalent employees over the period, or a reduction of salary or wages for any one or more workers that's in excess of 25%. So, but as to the amount required to be spent towards payroll, that's a minimum. Anything more than that is, I guess, just gravy.
Got it. Yeah, and just to clarify that, there was some guidance that came out very recently. I think that Rory mentioned earlier that the way this recent bill was originally drafted, you can interpret it that if you didn't spend at least 60% of the proceeds on payroll, you weren't eligible for any forgiveness. But that's not been clarified. So you can still spend, 50% on payroll and and then other 40% on other eligible costs and still have a fair amount of loan forgiven.
Mm-hmm. Okay. Here's a question related to FTEs. I have a question determining the FTE count. If I have an employee who was paid 32 regular hours and 8 paid federal sick leave hours, do I include the 32 plus 8 equals 1 FTE because it's federal paid sick leave, or is this employee only considered as 32 hours?
So the sick time, the sick leave pay would be included along with that calculation, in addition to the amount of hours that were actually worked and paid. I think the key is, what's actually been paid. But the one exception that I'm aware to that rule is to the extent that a business may seek a credit under the FFCRA, which is the Families for Coronavirus Relief Act, something to that effect. And if you're seeking a credit for that under that legislation, you can also pay out sick leave and get credit for that under the PPP program.
Got it. Okay. Are any employer-paid insurance costs like short-term disability or long-term disability covered under the loan? And can you clarify what classifies as retirement costs that might be covered?
Well, from my perspective, looking at it, I would say that it's employer-funded retirement costs that have been funded. So from that perspective, it doesn't matter what the employee has paid in, because it's what the employer contribution is what the focus is.
Okay.
Right. And there is a need for some clarity around the retirement contribution piece, especially around discretionary profit sharing contributions. This has been coming up a little bit with some discussions with our clients, because a lot of taxpayers will extend their return and wait to do their profit sharing contribution for the previous year until September, because they can, so they can defer the cash flow. But how does that translate into what's eligible for the period, for the 24-week period? And in general, for payroll costs that are eligible in that period are either payroll costs that are paid or incurred. So you get the best of both worlds from a cash method and an accrual method. But it doesn't seem like you should get credit for if you make a discretionary profit sharing contribution to a retirement plan during the 24-week period, but it was for payroll for last year. Does that count for that, for payroll for that, or eligible costs for the current period? So that's an area that there's going to be a need for some additional clarification.
Mm-hmm. Okay, here's a very specific question. What is the cap per employee for the 24-week period? It says it was $15,385, which I infer is a $100,000 pace of annual earnings. And it says, would that project at $46,154, which is a 24-week version of the pace of $100,000? So does that $100K cap carry over into this full period?
As far as we know right now, it does, and that's subject to anything we learn in guidance that may come out. That $15,385 number, that was annualized based on 8 weeks of the covered loan period. Now, since the covered loan period is 24 weeks, it would make sense that the maximum amount that you could pay to any one employee with the loan funds would increase in a corresponding manner. So again, I expect that that's what will be confirmed. However, that is still subject to some question, amongst all who are keeping an eye on this.
Got it. So the 24-week period, again, this is sort of parsing out what it means. Does the new forgiveness period of 24 weeks change the mandate that we have to keep the same employee count through what was June 30th, 2020? This date, which you said earlier, was extended to December 30th. What if they have layoffs during weeks 9 through week 23? How does that affect forgiveness calculations? Alan, are you going to tackle that one?
Sure. So that's an area that was somewhat addressed by the recent bill. And basically they said, if you can demonstrate the inability to reinstate your level of employment, return to previous levels of business activity because of the economic situation, then that headcount requirement won't work against you. So there really isn't a lot of guidance around that. So I think that's an area, again, I think the answer there is we're looking for more guidance in that area, but they certainly have liberalized the approach on that piece of the calculation.
All right, this one is a question that
Peter, oh,
yes,
sorry.
sorry.
I have one thing I think to add on that, sorry, that I think is important and maybe on the minds of folks is the question is when in time that's going to be looked at in comparing your employees. The best we know in the wording of the act is that it'll be looked at on December 31st, 2020. But does that mean that anything in the meantime from June 30th to the end of the year won't matter? And as long as you have the same amount or more of full-time equivalents on December 31st, will that make you eligible for full forgiveness? That's really the question is, what point in time is that going to be measured? And that'll be a very important piece of information that we expect to be clarified.
Got it. Here's a wishful thought for the 24-week period instead of our original 10-week estimate. Can someone say yes to that? Or no?
Peter, could you
I think we
repeat that?
missed.
Yeah, I missed the first part of that.
Sorry. Will the loans be increased to reflect the 24-week period instead of the original estimates? In other words, is there any increase in loan amount that goes with this new extension?
So the idea that now that we've gone from 8 weeks to 24 weeks, that the amount of the loan would increase, is that right, Peter?
It's a good idea, isn't it?
It sure is. I think you'd be pulling the rest. I'd be pulling the rest of my hair out if we had to do that. But as far as we know right now, there has been no discussion of that. But again, stay tuned.
Got it. So, John, another question for you. Does someone need to communicate with their banker whether they're going to pick the 8 weeks or the 24? What are you expecting to hear from customers as their initial period, the initial 8-week period arrives? Is there proactive communication you're expecting, or that Alan or Rory, you're recommending your clients communicate with their banker?
Well, at this point in time, we've gotten some soft inquiries as to, gee, my time frame is coming up. Should I submit it? And some of these folks are aware of the new rules, and some aren't. So the guidance is, hey, pump the brakes right now for some of the reasons we've already talked about, which is you need to make sure that if you're going to submit and hit that send button, that everything is in that package. You want to make sure that you have all your ducks in a row. And absent that, take advantage of the longer period of time. You have more ways to be able to justify issues or take advantage of safe harbors if need be. At least that's my take on it. I don't know how Rory and Alan feel.
Yeah,
go ahead, Alan.
Oh, yeah. As I mentioned earlier, I mean, I wouldn't be in a hurry to file this for all the reasons we talked about.
Yeah, and I would be concerned about not only using the loan funds for full forgiveness eligibility, but also using potentially a different application form that will have been different from the one that's the SBA is going to be used to receiving. And to the extent that that would occur, there may be issues and or just different ways that they would be the application would be looked at, and that could present delays or issues or requirements to submit. So I would have some concerns with submitting on the old application form.
Got it. Another question. I would love to see a definition of what's included under transportation. And a second question came up and said, can you clarify is utilities? Does that include internet costs? Not just, electrical and heat. Can you clarify what's included there?
So I don't, that's not been specified in any guidance or rule. However, I think it's very safe to believe that transportation would include gas and other auto expenses, and perhaps those expenses that might be typically subject to deduction on a business return. Mm-hmm. Things like, in addition to gas mileage, tolls, I think those are the low-hanging fruit. And whether there's anything in addition, I guess we're not really sure.
Got it. Okay. Would workers' compensation and liability be included in eligible employment costs? Did you hear that question?
No, so what's the question, Peter?
Would workers' compensation and liability be included in eligible non-employment costs?
Workers' compensation, what was the second?
Would that be included in eligible non-employment costs? The cost of workers' comp, is that forgivable?
It would not be included in a non-payroll, so it would not fall under the umbrella of, obviously, either a rent payment for personal or real property or a utility. I do not believe that workers' compensation insurance premiums would be included as a eligible payroll cost for forgiveness. And if these other guys can correct me or have anything else to add.
That's my understanding as well.
Yeah, I agree.
Got a question from a landscaping company who is seasonal, and they just want some clarification around how they measure their FTEs. Meaning, in February, there were very few of them on staff, right?
Yeah.
Especially with that extension through December, when a landscaping company won't, may have staff working through, October, November.
Yeah, there is guidance on specifically that. I can't recite it at the moment, but I will happily discuss that and be able to answer that, afterwards. And please feel free to reach out. Sorry, I don't have it at my fingertips.
Okay. Here's a question about the Mass Unemployment Work-Share Program. And this person has a staffer at 80% time, and they want to reduce to 50%. How can you get the PPP forgiveness now that the timeline is 24 weeks? Is the FTE still going to be a key calculation? But really the question is related to that Mass Unemployment Work-Share Program.
Well, I still think that everything is tied to full-time equivalents. However, that seems to be one of the driving forces behind seeking forgiveness. So I don't think that component goes away.
Got it.
But I think if that particular borrower can demonstrate that they couldn't return to previous levels of business activity, let's say they're a restaurant and they are limited to only being at 20% capacity. I think the intention of this bill that was recently passed is to not have that FTE calculation be a limiting factor for them. But that's one of the things where we're still looking for guidance.
Got it. And just another question in on it, and I think you've answered this, but I just want to make sure. We have had the same amount of employees in the 8-week period, but we're going to be going down by 1 FTE as we move into the 9th week and beyond. And how is that impact loan forgiveness on the 24-week cycle? Just clarity on that?
Yeah, well, I think that as I mentioned before, the covered period is extended to December 31st, and that covered period will be the trigger for any forgiveness reduction for a reduction in full-time equivalent employees. The question I think that still remains is, at what point in time will the FTE calculation be measured? Will it be measured on December 31st of 2020 and as compared to the 2 prior reference periods, or will it be looked at different for different periods? So I think that still remains to be seen.
Right.
That answers the question.
Okay. And I've got one more. The new rules affect how much can be deducted for employees that earn over 100K. Does that, again, I think it's the same question about that 100K extending through that cap, extending through that entire period through December 30th. And I believe you said it did, Alan, is that correct?
Yeah, the same rate of payroll, or the same annualized payroll, still applies.
Okay. And then, sorry, one more. How does the EIDL grant, how does an EIDL grant affect a PPP loan if someone got both?
So my answer to that, and I welcome anyone else's input, but as long as the funds used under the different programs are used for different purposes, then I believe that they can be used in conjunction. Both loans can be applied for and used.
Terrific. All right, so we're at 55 minutes. Kind of at the end of the program. We've had a lot of good questions and a terrific conversation. And I just want to thank all of our panelists, Rory and John and Alan, for a fantastic job presenting today. And also want to thank our sponsors, Webster 5, Fallon Health, and Outage, for helping to make this program happen.